If you're a small business owner who wants to learn the basics of financial statements, this video was created for you. Stick around. Hey there, I'm Brian, the co-founder of Impact Bookkeeping, where we specialize in bookkeeping, financial reporting, and CFO services for small, service-based businesses. We created this channel to positively impact the financial future of small business owners across the world. So if this information is helpful, subscribe to the channel and hit that like button. Alright, let's get started with the financial basics for small business owners. Financial statements are like a dashboard for your business. They tell you what your company owns and owes at a specific point in time, whether your operations are profitable, and how much cash flows in and out of your business. You may also need them as part of a business plan for your startup or to get approved for business credit. Now, let's go through and review each of these three main financial statements your business needs and the purpose each serves. All right, let's take a look at the income statement. An income statement, also known as a profit and loss statement, shows what your company earns, as in revenue, and spends, as in expenses, over a period of time. It could be for a month, a quarter, a year, or multiple years. When you look at your income statement, you likely look at your net income, also known as your bottom line. This tells you whether your business earned a profit or suffered a loss. But there's a lot more to discover in your income statement, especially when you use it in conjunction with your balance sheet. Here are some examples of what we can learn from the income statement. How does this period compare to the last accounting period? Looking at your income statement for 1 month, quarter, or year can be useful, but a comparative income statement is more informative. This type of statement shows the results of 2 or more accounting periods in separate columns, giving you a view of how the business is performing over time. For example, are revenues trending up or down? Did your cost of goods sold increase significantly from last year to this year? Are your overhead expenses rising or shrinking? Are you more profitable in certain times of the year? Comparing each line item can help you uncover troubling trends or errors within the financial statements. Gross profit margin and operating profit margin. Subtract your total cost of goods sold from your total revenue, and then divide that number by your total revenue to get your gross profit margin. This metric tells you and anyone looking at your financials how profitable the fulfillment side of your product or service is. Now, to get your operating profit margin, subtract your total cost of goods sold and your overhead expenses, not including your taxes or interest, from your total revenue, and then divide that number by your total revenue. This metric tells you how efficiently your business generates profit from its core operations. It can also tell you whether you have too much debt. Dividing your company's total earnings before interest, taxes, and depreciation and amortization, also known as EBITDA, by the annual principal and interest payments on all loans, the result is your debt service coverage ratio, DSCR. Many lenders use it to determine whether or not to give you a business loan. While each lender has its own requirements, loans backed by the SBA generally require a DSCR of 1.15 or greater. We can also determine how efficiently you turn over your inventory. For many businesses, keeping inventory in hand is critical for meeting customers' demand, but having too much of the wrong inventory can lead to cash flow problems. Divide your average inventory by your cost of goods sold for the same period. The result is your inventory turnover ratio. For most industries, a good inventory ratio is between 5 and 10, meaning the company sells and restocks inventory roughly every 1 to 2 months. However, an ideal ratio for businesses with perishable inventory such as grocery stores, restaurants, and florists may be much higher. We can also determine how quickly you collect accounts receivable. Divide your average accounts receivable by sales for the same period. The result is your receivables turnover ratio, and it shows how quickly you collect the money that is due to you from customers who buy on credit. While a good receivables turnover ratio varies by industry, in general, the higher the better. A higher number means your customers pay on time and you are good at collecting receivables. All right, guys, now let's take a look at the balance sheet. A balance sheet shows your business's assets, what it owns, and liabilities, what it owes at a specific point in time. When you subtract liabilities from assets, the difference is shareholders' equity. Shareholders' equity shows how much you and your business partners, if you have any, have invested in the business, either by investing cash or other assets into the business or by retaining earnings of the business over time. Ideally, you should have more assets on your balance sheet than liabilities, as this indicates a positive net worth. Other important information you can gather from your balance sheet includes liquidity. Divide your company's current assets, such as cash, accounts receivable, and inventory, by its current liabilities, such as accounts payable, credit cards payable, accrued expenses, and short-term debts. The result is your current ratio. If your current ratio is less than 1, this is a red flag that you could have liquidity troubles. You may need to invest more money into the business or get a small business loan to keep the company afloat. It also includes the ability to distribute profits or pay dividends. Do you have a lot of cash on hand and few debts? Distributing that surplus in the form of distributions or dividends can give you and your business partners a return on your investment. It also includes the ability to reinvest in the business. You can also reinvest excess cash into the business by purchasing real estate or equipment. It also includes assets that can be sold or retired. Do you have assets on your balance sheet that you no longer use? Selling them for cash can improve your business's liquidity. And the third and final statement is the cash flow statement, also referred to as the statement of cash flows. A cash flow statement shows how money flows into and out of your business over a period of time. It shows what your company is doing with cash, spending, investing, or distributing to shareholders, and where that cash is coming from, operations, investing, or financing activities, and how much cash the business has at the end of an accounting period. Your cash flow statement can tell you whether you have a positive or negative cash flow. It's possible to have healthy revenues, but be cash poor. This can happen when you have too much cash tied up in inventory or receivables, or are growing too quickly, which is draining your cash faster than you can bring it in. Any business can experience a cash flow crunch from time to time, but few can sustain negative cash flows in the long term. So this is an area you want to keep a close eye on. All right, we wanted to throw in a bonus for you guys and talk about a cash flow forecast. A cash flow statement shows where the money came from and went in the past, but a cash flow forecast helps you predict the future by estimating cash coming in and going out based on past performance. A cash flow forecast can help you determine when you may have a cash shortfall. If you're going to have more cash going out of the business than coming in, it's better to know sooner than later. This can help you plan for cash shortages by securing a business line of credit, adjusting the timing of payments to vendors, or speeding up receivables collections. It can also help you determine whether you should pay for future initiatives with cash or with a small business loan. You don't want to sink all of your available cash into building a new location or purchasing equipment just to run out of money and have to lay off employees. A cash flow forecast helps you plan projects and secure financing when needed. Okay, so the last thing we wanted to cover is how Impact Bookkeeping can help. It's totally possible to handle your own bookkeeping and prepare your own financial statements with the help of accounting software or financial statement templates. But the chances are you have enough responsibilities as a business owner. That's where partnering with Impact Bookkeeping comes in handy. An experienced bookkeeper can prepare financial statements for you so you can make financial decisions and keep tabs on the financial health of your business without spending hours classifying transactions and reconciling accounts. Plus, when it comes time to file your income taxes, you know that your financials are 100% correct and ready to be handed off to your CPA or tax accountant. Don't have a bookkeeper? Check out Impact Bookkeeping at www.impactbookkeeper.com. We'll handle the bookkeeping for you, prepare financial statements every month, and spend time making sure you understand all of your business's key numbers. Well, that's it for today's video. Thanks for stopping by, and we wish you the best of luck on your business journey. Take care.